Good afternoon, everyone. Thanks for joining us for Understanding Your Retirement DNA. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CPE, CIMA, CPWA, CIMC, RMA, CFP, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive a link to replay today's broadcast. So let's get started. We are joined today by Kate Blake, Instructional Designer and Technology Trainer at Pentegra. Kate has been with us since the beginning of her career, where she started in the retirement benefits field. And being the quick learner and talented contributor she is, Kate quickly arose into various positions within Pentegra. Kate's been able to exemplify her deep roots of industry expertise in each position she's held, and her skills have always been the perfect complement to Pentegra. Kate, I'll turn this over to you, and we can start talking retirement plan DNA.
Great. Thank you so much, Lizzie, for that introduction, and thank you to all of our attendees for taking the time out of your busy schedule to join us today. We have a lot of material to get through in the next hour, so I'll start by identifying our learning objectives. Today, we're going to be discussing our retirement plan DNA, and I'll expand a little bit in just a moment about what that specifically means and the components of it, but I've listed them here. So understanding not only how the plans that we work with and participate in, because we're all savers as well, not only how they work, but also how we can tailor the provisions specific to each of these plans and plan types to the needs of our plan partners and actual users of the plans. And what does that look like? It looks like understanding your plan's unique options, understanding how to use provisions for our partner, adopting employer, or plan sponsor, or plan participants' needs, how we can take advantage of special tax rules in order to assist plan participants in obtaining more favorable distribution taxation, and how we can advise people that we partner with and work with on these plans to use the best source types for them. More on all those topics in just a moment. But before we dive into them, let's actually talk for just a minute about retirement DNA. We can compare this to our physical DNA. You know, we all are born with certain characteristics that are fixed and can't be changed. This can be our hair color or our eye color. And that reflects our DNA, and those are our genetics. But, you know, if we think about the field of science, we can think about the field of epigenetics, which has cropped up over the last couple of decades, which talks about how not only do we have specific DNA that is fixed within our cells, but that DNA can be expressed in ways that reflect choices that we make within our own lives. In other words, you know, we may have a certain lot in life and we can't necessarily change that. You know, we may all want to offer the best possible traditional defined benefit pension plans for the plan partners that we work with, but the reality is we can't always do that. But maybe we can offer a very strong defined contribution plan as the basis, as the DNA, that we can then help our users of these plans maximize in the same way that epigenetics relies on things like eating well, making sure we get vitamins, exercise, and rest in order to maximize that physical DNA. And I think that there are really three approaches that we should consider as we move through this presentation. I think we should think about retirement DNA from the perspective of an employer, an advisor, and a saver. And I expect everyone on this call to fall into at least one, maybe two of these categories. And the reason why I think it's important to consider all of these categories and all of these, goals, even though you may only particularly experience or resonate with one or two of them, is because everybody's going to have different DNA. And the expression of our DNA is going to be different for everybody. And that is something that I myself have had to learn over the years in my roles here at Pentegra and in the retirement industry. So let me talk about these three perspectives that we can use to frame this discussion of retirement DNA. So as an employer, and maybe you are an employer sponsoring a retirement plan, maybe you work with employers sponsoring retirement plans and have, for example, a book of business of sponsoring employers. Perhaps you work with MEPs or groups of plans. From that perspective, when we're wearing our employer hat, retirement DNA means, how do our retirement offerings set the stage for the employee savings and financial wellness experience? So as an employer, we're creating the DNA and the framework. As an advisor, how do we help our clients, and our clients could be employers and or savers, so how do we help them from different perspectives maximize those options? Just like an employee has fixed DNA with regard to, I can't change the number of loans that are permitted in my retirement plan, employers also can have fixed DNA as well. While an employer may want to offer, again, a substantial, say, safe harbor benefit, a budget may not allow for it. So as an advisor, you're in the position of considering both sides of the coin. And then as a saver, are we fully aware of the blueprint of our own retirement plan DNA? And as a practitioner at the same time, when we're thinking of our own experience and helping people and using that to help people understand their experience, we have to make sure that our own retirement DNA doesn't cause blind spots when we are advising other people. It's really easy to look at saving through the lens of our own DNA, even when we're providing services to others. I'll give you an example. I have a son. So for me, when I'm thinking about retirement planning for myself, I'm thinking about estate planning, legacy, beneficiary designations, and things like that. But if I'm meeting with somebody who has a different retirement DNA, maybe they don't have children and they have other needs that are of higher priority. It's important to me as a practitioner to acknowledge, understand, and respect their DNA needs in addition to my own. And that's why I think it's important not just to look at it from one perspective or the other, because I think all of these perspectives are valid and interrelated. So as we continue through today's presentation, we'll look at different components of a retirement plan, DNA makeup. What makes a retirement plan a retirement plan? Provisions include what we see here, rollovers. Retirement plans typically allow rollovers in and out, and that is a blueprint of a retirement plan. But again, the way we express that blueprint depends on our needs, our role, and our goals. And we'll continue to look at other provisions that are present in many different types of retirement plans that express themselves in different ways over the remainder of this hour. So we'll start with the rollover. We'll look then at different types of distribution, tax implications of employer stock, and we'll also look a little bit at lump sums, especially with regard to defined benefit plans. And I think you'll see with all of these different types of DNA that it just serves as a blueprint, and that there are so many different ways that we can express this DNA with both ourselves and our savings habits, but also the people that we partner with, and ultimately the folks who we provide services to. So this is a little bit about rollovers. I think we have a lot of retirement plan professionals on the line today. So I think many of us are familiar with the general ideas around rollovers. So, if you don't roll over your funds and you are under age 59 and a half, there is that 10% early distribution penalty, with some exceptions that apply in the case of substantially equal payments over a period of at least 10 years. Taxes and penalties don't apply if the distribution is directly rolled over. Qualified plans generally must withhold 20% of assets unless the distribution gets directly rolled over. That's for federal taxation. And of course, investors should take into account any potential tax consequences as well as expenses, sales charges, and penalties for selling and buying investments before initiating a rollover. So how does this translate to the expression of retirement DNA? Well, let's start with the last bullet point here. All retirement plans are different. And while most retirement plans that I've seen provide for rollovers in and out, at least DC style plans, 401k style plans, they all have different fees and expenses that are associated with that. So for example, if I'm an advisor and I am taking stock of somebody's retirement DNA, what I would first do is I would ask them to make a list of all of the plans that they participate in or have access to. And that could include things like a 401k, perhaps an old 401k from an employer that they have since left, and perhaps maybe they have an IRA of their own as well from maybe an even older employer. That's 3 different accounts. And I might want to, help an employee or somebody that I'm advising clean up those accounts. I might inherently want to recommend they move it to their IRA because there may be more investment flexibility. There may be a brokerage IRA available that may be reasonably low cost. But I have to consider the DNA of the individual. Are there certain things that need to be taken into consideration that might make me recommend them leave that money in the 401k? For example, 401k assets are exempt from creditor claims. 401ks also frequently have, pre-designed fund menus. So if I feel that this is somebody that maybe doesn't have a good handle on investing or a good comfort level with risk, an IRA might not be right. On the flip side, I want to make sure I look at fees in all of these plans as well, because that's part of retirement DNA also. So if a 401k has high fees, then that might be an argument to move it to the IRA. So lots of different things to take into consideration that are under the surface that are impacted by these regulations that we all know and are familiar with. The key is how we take our understanding of these regulations and apply it to the individual experience of the users of our plans. Like I mentioned, most plans permit rollovers in or out on the DC side of things. Typically, for pension plans that I see, they usually permit rollovers out only. So you can't typically roll, say, defined contribution assets into a defined benefit plan. And you might be thinking, Kate, defined benefit plans are going the way of the dinosaur. Why are you even talking about this? But this is actually a really material point right now for anybody who's been watching the DB industry and following the movement of interest rates. You may know that there is an inverse relationship between rates and pension plan liabilities. What does that mean in English? As rates rise, it becomes cheaper for employers to unload these long-standing traditional defined benefit pension plans. And what does that mean when all of this is happening? Well, it means that employees, many of them, when these plans terminate, have the opportunity to act on this money. So, should you take a pension lump sum? Should you roll it over again to the IRA? Or should you choose an annuity? We'll talk more about that in just a moment. But that's another aspect of somebody's retirement plan DNA. And, again, our DNA in and of itself can't be changed. We have a defined benefit plan just like we have blue eyes. I can't change what my employer offers. But if my employer is moved by outside forces, again, just like the idea of epigenetics as it applies to our DNA, if my employer is moved by outside forces, interest rates, to change the offering, well, now that impacts me and affects my own retirement plan DNA. And again, comes back to, needs of an individual and how those rules and regulations impact those individuals' retirement readiness and options that are available to them. And then, of course, we have our IRA-based plans as well. I don't want to leave those out. There are simple IRAs and our STEP. There are some rules around rollovers in and out of the simples, or into the out of the simples, I should say. Assets may be rolled over if the account is held for at least 2 years. So in addition to understanding the different accounts that are out there, if we're advising somebody and they make us this kind of a list, what we would then do as a second step is just like what we have in parentheses here. Say, okay, great, you've got all these different plans. What types of distribution options do you have? Notate lump sum if they have one from the DB plan, whatever they have from their 401k plans. This way you have a list for somebody, you know what's available to them, and you can work with somebody or yourself, if you're thinking about yourself as an individual saver, to figure out how this DNA, again, impacts and is impacted by your needs. Time for our first poll question, and it is about distributions of pre-tax dollars. So generally, distributions of pre-tax dollars from a 401k plan are exempt from federal income tax and penalties, subject to federal income tax and might be subject to an early distribution penalty, exempt from federal income tax and penalties if directly rolled over, or D, both B and C.
The poll should now be launched on your screen, and I will leave it up for about 45 seconds to a minute for everyone to select an answer. The poll is now closed. The correct answer was D, both B and C. Kate, you may continue.
Thanks so much, Lizzie. So remember, again, these rules are going to be subject to everybody, but our expression of the rules depends on our needs. So if I'm under 59 and a half, I've got that early distribution penalty. So if I'm contemplating early retirement, relying on 401k resources immediately probably isn't a good expression of my retirement plan genetics. I might want to look to other options or look to exemptions from this penalty, one of which is rolling it over. If you roll it over, there is no federal income tax, there are no penalties. But again, the plan has to provide for it. And that's why, from the advisor perspective, if you're working with an individual to help them understand their DNA, it's important to have that list, like we looked at on the prior slide, to say, what do you have, what's allowed out, and what's allowed in. And also, as we mentioned, advisors really do need to look at both sides of the coin. So if you're helping employees, that's one perspective. But then if you're helping employers, that's another perspective. How is your plan set up? What funds do you allow out? What funds do you allow in? And before we move on, just one more thing from the advisor perspective that I see frequently. Do you allow rollovers in prior to satisfaction of eligibility requirements? Allowing people to roll funds from prior employers is a great way to capture those assets before they get moved to outside IRAs. So that's a great expression of retirement plan genetics, both from the participant and the employer perspective, and one that I would encourage advisors to look at having any partners that they work with adopt. So what other things are there to consider when it comes to these types of rollovers? There are upsides and downsides. And here, again, it depends on our retirement plan genetics. So if we have a defined contribution plan, we probably have a good amount of flexibility with our rollover, but generally, we can't take them prior to age 59 and a half in a defined benefit plan. And ditto for in-service distributions as well, although there are some exceptions to that rule. That all said, though, the defined contribution plan, your 401ks and things like that, it's going to be more liberal, as we said, than your defined benefit plan. Now, as we also already said, we typically don't see our defined benefit plans that much anymore. But if all of your experience has been like my experience over the last, say, 12 months or so, we're starting to see a lot of movement on these DB plans where we hadn't for many, many years. And that provides opportunities really for us. It provides opportunities to win new business, new assets. It provides opportunities for education. It provides opportunities for advisory services. Do you need help terminating this plan? Do you need help explaining to your employees what to do with this benefit? So, the change in interest rates has really opened up a lot of opportunity around defined benefit distribution consulting that wasn't previously available. And also because DB plans are so infrequently seen these days, that's really a niche skill that is really in demand now for people who have these plans. And it's just so critically important because you only get to make a choice with regard to your benefit form in a DB plan once. And we want people to make the right choice. We want them to express their retirement plan DNA in a way that is most beneficial for them. So for our DB plans, typically the default there is an annuity. So a monthly payment that you can't outlive that will get paid for your lifetime. The lump sum, and by extension, the rollover, is what we call an optional form of benefit. So it's not usually the default option in a defined benefit plan. It's never the default option in a traditional defined benefit plan, but it is increasingly becoming an option that we need to explain the pros and cons of to employers and employees. And then again, our IRA-based plans. So these are distributable on demand of the IRA owner. But again, we have taxes and penalties. But again, just like our defined contribution plans, we have exceptions to those penalties, including Rule 72T, which is an exception from that 10% early withdrawal penalty if you meet certain age and distribution frequency requirements. And that, too, is a great example of the service that we as retirement plan practitioners can provide on both sides of the coin again, both to employers and employees. This is a lot for employers to understand. Typically, if you're offering an IRA-based plan, not always, but in my experience, you're probably going to be a small employer. You're probably going to have a small HR department and a lot of other priorities. So advisory services and plan partnership services are really important with these IRA-based plans for those reasons, but are really often overlooked because, again, the plans generally are small. It's not a huge driver of revenue for advisory services, but there definitely is a demand, especially as we see baby boomers in and nearing retirement, many of whom have changed careers a number of times over their lifetime, many of whom may be or have been at some point in their lifetime small business owners, and almost all of whom, I would argue, are unable to identify which types of plans they have in their retirement plan DNA, and many of whom are certainly unable to identify these pros and cons and rules around them as we are doing here. So you can see how this, as times are changing with rates and the demographics of this country, how this understanding becomes really translatable to employers and plan participants' needs. So read the fine print, and that's really what this is all about. All of these plan provisions that we're talking about today are defined in retirement plan documents. So whether or not your plan accepts rollovers, whether or not it allows for those rollovers prior to the satisfaction of eligibility requirements, those are all typically, check the box in, an adoption agreement. So the first step, if you're an advisor working with employers, or if you are an adopting employer or plan sponsor yourself, is to make sure you know what your document says around all this stuff. And typically there will be separate categories for each one of these things. So in-service distribution, we kind of talked about some of that stuff already and some of those rules. those are typically detailed in a distribution section of your plan document. Your contribution section of your plan document will detail the different sources that are available to you as an employer or as somebody who works with an employer, and to your employees. And there's a lot of nuance there as well that we'll talk about in just a moment. And again, we already know because we talked about it, there's a lot of nuance around those DB lump sums. That too is going to be something that is reflected in a plan document and any special provisions around that. If your plan has stock, or if you work with plans that have stock, we're seeing more and more of those these days. The NUA rules are critically important and are a function of plan type. So interestingly, not all plans are going to have the NUA rules apply to them. So you want to make sure if you're an advisor working with plan sponsors or employers that these plans are set up properly and provide for these NUA benefits, which we'll describe in just a moment. So the document is always going to be key across all of these discussions. Before we get into this section, just some thoughts about the document being key. As you know, if I'm wearing my advisor hat, the key document that I would look at from the employee perspective is the SPD. Of course, I would make sure I have that handy and make sure any employees understand that. And then the adoption agreement would be key from the employer perspective. If you work with a record-keeping partner, they likely manage and or keep copies of those documents. So if you don't have them, you can get those from them. And that's something that any advisor or plan practitioner should have handy, because regardless of what the federal rules are or any rules around these plans, the documents tend to offer a lot of flexibility. So you might think, oh, this plan just offers pre-tax and Roth and the limit is what it is. But as you'll see in a minute, there are other types of sources like after-tax sources and things like that that kind of go beyond. So always important to review that plan document because it is the document of record and what, again, determines the expression of our retirement plan DNA. A lot of types of plans allow us to access or offer access to these assets while our plan participants are working. So typically you'll see that in your 401k type plans, you'll see that in your 403b, your profit sharing plans. Once in a blue moon, a traditional DB plan offers in-service, although I see that less frequently. But it's not a guarantee. So, again, even though you might think you know what the federal law is, federal law provides for in-service distributions. An employer doesn't have to offer them. Or even if they do offer them, they can restrict availability to age, to certain sources, to a certain amount of service. 2 years is pretty common, like you can see here, or for a reason, like financial hardship. So while the DNA, the basis for the DNA is in-service distribution, what we allow as retirement plan practitioners, partners, employers, and plan sponsors is what's going to determine the expression of that DNA for our employees and plan participants. So we want to make sure we get it right for them. And for this, I would encourage you to think about the demographics of the people who are using these plans. So before I moved into the role in the training department where I currently am, I was a consultant and I traveled around the country. I had a book of business of about, maybe 50 different employers that I worked with. Did annual plan reviews, looked at plan design and things like that. And I would say that no two employers were the same. And not only did they have different needs, but the needs were a result of their differing demographics. So for example, if I was a startup and I was attracting a lot of young employees, I might want to restrict my in-service withdrawals to an age basis because I don't want young people who may not be well educated in this stuff to be drawing unnecessarily on their retirement plan assets. Or consider the situation, we saw, over the last year with inflation. I know that it is becoming a lot harder for people to meet their living expenses, their day-to-day living expenses So on the flip side, maybe I open up the plan a little bit and offer reason-based distributions if I don't already, like hardships. So what we offer not only affects people, but is affected by the people that we're offering it to. So I think we all probably have pet provisions that we like. I mean, I am biased. I will admit I like to see assets remain in the plan. So I try to encourage employers to adopt provisions to prevent leakage. But to come back to my example again earlier about, me being a parent and not being, held captive by my own blind spots, I have to acknowledge that sometimes, as a parent, people might need to access their money. And even though as an employer, I might not want to offer it, or as an advisor, I might not want to offer it, we have to admit that different people have different needs, and sometimes those needs require the framework for, allowance of in-service distributions. So really based on your own individual demographics that you specifically are working with. I love after-tax accounts, and this is another great expression of retirement DNA that I think a lot of people are not familiar with. So I think most of us are familiar with pre-tax and Roth, right? So pre-tax is exactly what it sounds like. The money goes in on the before-tax basis, and then when we take the money out in retirement, it's taxed at ordinary income rates. So that's the traditional thing that most people do. Roth came to 401k plans several years ago at this point, similar to a Roth IRA, their after-tax contributions. With Roth, when you take the money out, everything is tax-free, provided you meet the eligibility requirements. After-tax is different. So there's Roth, and then there is after-tax non-Roth. And that's what I want to talk about here, because as you'll see in the first bullet point here, nearly 25% of 401k plans offer after-tax, non-Roth contribution accounts. And what this tells me as a retirement plan consultant is that 75% of 401k plans don't offer after-tax Roth contribution accounts. And this, again, is just, a way that we can structure the retirement plan DNA for our employees and plan participants that we work with so that they can maximize the epigenetics of their experience. And if we're not doing that, then they can't maximize their experience. And I think this is an area where a lot of us are not building the framework to allow people to maximize their retirement plan DNA by contributing as much as possible. So after-tax amounts, the way they work, they go in just like Roth. They go in on an after-tax basis. But then when you take the money out later on in retirement, your basis, or the money that you have put in, is tax-free, but your earnings are taxable at ordinary income tax rates. So you don't get all the same benefits as Roth. As you can see here, it's separate from a designated Roth account. It's just a separate source within the 401k. But even though you don't get all the same benefits, it does give you different types of benefits. And I guess I should say different types of flexibility. So typically your after-tax accounts, they're going to be eligible to be withdrawn for any reason. Typically, it's going to be penalty-free. So for example, many 401k plans allow hardship withdrawals for the purchase of a principal residence or loans for the purchase of a principal residence. This is great. This is very noble, and many people make fantastic use of these provisions and go on to become successful homeowners. But it's not ideal, because if you're under 59 and a half and you take a hardship, even if it's to purchase a principal residence, if you're under the age qualifier, a 10% penalty is still going to apply. It's just not the most efficient use of funds. And with a loan, you have to pay it back, which is good, but it's a drag on somebody's cash flow, again, from the participant perspective. And to a new homeowner, that matters. Consider instead a 401k plan that allowed for after-tax contributions, where somebody could contribute a portion of their deferral amount or all of it to an after-tax account, which could be withdrawn any time for any reason without penalty. That's just a lot more efficient and powerful use of assets in my mind than using the hardship or the loan feature. So it's a great reason to consider recommending your employers or adopting employers and plan sponsors that you partner with to adopt these provisions. You can counsel the plan participants that you work with on this too. So, I don't think that after tax is perfect for everybody. Pre-tax is going to be useful for people who want to contribute with the smallest impact on their wallet because there's no taxes being taken out. So that's for somebody who really is concerned about maximizing their economy and their dollar today. Roth is useful for younger people who can afford to, have the extra bite come out of their paycheck, who can, pay the taxes today. I think both pre-tax and Roth are really powerful and have a time and a place. The after-tax is really going to be useful for your super savers. And this is another reason why it's beneficial. So the after-tax ties into not the 402G limit, which you guys know that's the 22,000 or 22,500, or the 30,000 if over age 50 this year. So just the annual pre-tax and Roth limits. After-tax ties in with the annual additions limit, which is $66,000 this year. The annual additions limit is the sum total of everything that you can contribute to your account. So it's the max of the pre-tax, Roth, employer, and after-tax contributions. Everything that you put in cannot exceed $66,000 this year. But what that means is, let's say I put in up here, $30,000. I maximize my pre-tax and my catch-up. I still have between $30,000 and $66,000 of contribution base, so to speak, until I reach the annual additions limit. So if I get another $10,000 in employer match and maybe $40,000 has come into my account during the calendar year, well, the annual additions limit is $66,000. So I could still contribute another $26,000 on an after-tax basis. So there's a lot of benefits here for somebody who wants to go above and beyond that regular 401k pre-tax and Roth limit and have additional flexibility on top of it. So again, it's not for everybody. I mean, I think, again, pre-tax and Roth are really beneficial, good for the everyday saver, but there are a lot of people out there, especially super savers, people with dual incomes who really want to maximize that, who would very much benefit from after tax. And as we saw, it's very underrepresented among plans. So definitely something to consider. After tax also has a really neat provision where you can split your distribution in a way that is more favorable for tax purposes. So if I take a rollover of my distribution and I have after tax, the technical terminology is down here, split post 1986 contributions and earnings. What this means is that I have after tax money and I have pre-tax money in my account. That's what's in this bucket in the middle. And what Notice 2014-54 says is if I take a distribution, I should say if I take a rollover, I want to be clear. If I take a rollover of everything in this bucket, so it's a mixed bucket, what this notice says is a participant, even though it's coming from one bucket, because it's a mixed bucket, you can split the distribution into like recipient buckets. I guess that's the right way to say that. In other words, your pre-tax money would go to a traditional IRA and your after-tax money would go to a Roth IRA. And even though I'm familiar with Notice 2014-54, I actually had to go back before this presentation and just fact check myself because it is just such a favorable provision. It's hard to believe that they actually kept it. But what Notice 2014-54 actually did was not only keep the provision, but double down and reiterate its applicability. Because if you're astutely paying attention here, you remember I said a second ago that after tax doesn't have all the same benefits as Roth because our principal was going to be taxable, but it has additional flexibility. Well, under 2014-54, you're getting that more favorable taxation just by distributing the funds in the right way. But you have to be cautious here because, number one, you have to make sure that the administrator that you're working with is aware of this provision and is able to operationally implement it. So for advisors on the call who have a book of business where after tax is a material factor, notice 2014-54 is something that you should bring up with your administrators and ask them if they can accommodate for it. Also, from the participant perspective, you can't just willy-nilly take a distribution of your assets and, have a nice day. I'm going to go off on a nice cruise somewhere. You have to roll the funds. And this, again, is just coming back to that idea. I love the title of this presentation, just understanding your retirement DNA, because the DNA is the DNA. Again, like if you have after-tax contributions, good for you, you have after-tax contributions. But what a lot of people just really don't realize is that the expression of that DNA, in other words, how you proactively manage those after-tax contributions or your in-service withdrawal provisions or your rollover provisions, as we've talked about, all of those other ones, how much that impacts not only our employer experience, but our participant experience as well. And, I think too, when I used to do these plan reviews, people get really focused on the big ticket items, like when can people come into the plan and how much am I going to contribute as an employer? And this kind of stuff really gets lost in the nuance. It's rare that I ever get to have, a long form discussion about after-tax contributions and why they're beneficial. And again, I think seeing that only 25% of employers use this, I think that is representative of the industry as a whole. So I hope through presentations like this, it can encourage more plan practitioners to, just kind of think beyond those big ticket items and think about these smaller ways that really can have huge impacts on the participants that we, are trying to work for here. Some things to think about. Do you have an after-tax account in your 401k plan? So I think most of us on the call today are practitioners. These are questions that you can ask retirement plan participants. So this is kind of a guide for you, in your work with employees. Ask them, do you have this after-tax account? If yes, let them know a little bit more about what it means. Let them know that it allows them to go up to that annual additions limit of $66K. Let them know that it can be an effective way to acquire Roth assets. Again, if they roll it using that notice 2014-54, they get the favorable treatment where they can roll into a Roth. If they don't know what after-tax is, then you're having a different discussion. Now you're whipping out that SPD that we talked about before, and you're talking about the different options, just like we did earlier. And if the plan doesn't have the option, that again is now a third type of discussion. This is where you go to HR. You can share, I think today's being recorded, so you can share what you learned today, talk about the pros and cons, and ask if it's something that they are interested in considering adding to their plan. There are some administrative considerations. I mean, after-tax money does have to be tracked separately. It's not a huge deal, but it's just something to know. And there are some other, considerations. If you do add after-tax money, you'll have to think about how any other provisions apply to that. Can you take loans on it? Can you take in-service distributions on it and things like that? But it's a great provision and one which I wish more retirement plans offered. All right, it is time now for our second polling question. With respect to standard after-tax contributions in 401k plans, check the plan document to determine whether a 401k allows for after-tax provisions. That's option A. B, after-tax accounts can facilitate tax-efficient Roth conversions. C, the IRS requires all plans must allow for after-tax contributions. Or D, A, and B.
You will see the poll launch on your screen, and again, I will leave it up for about 45 seconds to a minute for everyone to select an answer. poll is now closed. The correct answer was D, both A and B. And Kate, you may continue. Thank you.
Great. Thank you so much. So yeah, I think this one was kind of a giveaway based on what we talked about earlier. This is an underutilized feature, but it has a lot of uses with regard to tax efficiency and other uses. All right, we've got about 14 minutes left, 2 more topics and 1 more poll question. So I might pick up the pace just a little bit as we cover NUA in employer securities, which is net unrealized appreciation. So what we're talking about here are plans that offer employer stock. And what we're saying is, if you have a plan participant who owns qualifying employer stock within a 401k plan or other eligible qualified plan, that could include, for example, a KSOP, and if they are eligible to receive a lump sum distribution that includes in-kind shares of stock. This is very important. When I say in-kind, I mean in stock. If the plan only allows for cash distribution of stock, the special NUA rules don't apply. So right off the bat, I can tell you if this is like, like privately held stock or something like that, or something that trades on, doesn't trade on a major exchange, things like that, then you might have a hard time with these rules. But if you work with, say, a large employer, if it's, a stock that is traded on the NASDAQ or the NYSE or something like that, then this is definitely an option. So with that established, knowing that if the participant can take a lump sum and if they can take it in stock, then they are eligible for this favorable stock treatment. And this is favorable for some people and not favorable for others. So this is another example of why that retirement plan DNA matters. So what we're saying here is, upon distribution, if I take the money in kind and put it in a brokerage account, the cost basis of what gets put in, which you can see right here in this example, let's say it's $75,000, this is taxed upon distribution as ordinary income. But if I'm taking a distribution of $350,000, anything that is associated with growth or earnings on that money is not taxed at the time of the distribution. So right off the bat, deferred taxation with special NUA tax treatment. Number 2, when I go to sell my shares later on, because remember, I've transferred them in stock to another brokerage, then I get even more favorable tax treatment where my earnings are taxed not at ordinary income tax rates, but at the long-term capital gains rate, which for many folks is lower than their ordinary income effective rate. So you can see why this can be really favorable. I would say this is really favorable for somebody who is a high earner, somebody who is a dual earner, somebody who, especially like you can imagine a participant in this plan, and maybe they are a participant in a non-qualified plan, and maybe they elected to receive those non-qualified distributions upon termination over, a series of installment payments. Well, if you think about that, what that means is now this person's probably going to have a big tax bill from their non-qual plan after termination, and maybe they don't want a big tax bill from their KSOP on top of it. Well, you can imagine that that's a situation where these NUA rules become really favorable really fast. But, if I'm a rank and file worker, not a high earner, have a stay-at-home spouse, not looking to minimize my tax liability or tax efficiency because maybe my ordinary income rate is equivalent to the long-term capital gains rate, this is probably not favorable. Because the trade-off here is you can't roll it, right? You're moving it to a brokerage. So some people want to preserve the qualified retirement plan account. And you can't really do that with these rules. So it's good for some folks, not good for others. So again, thoughts for you as you move, into your practice areas after this presentation. Ask people, when was your last NUA analysis? I can almost guarantee you're going to get this answer, which is I have never had one. And I'll expand on this, probably somebody saying, I don't even know what this is. And this is a great, if you are a retirement plan practitioner and advisor, I would say this is actually a great untapped revenue opportunity because, again, we have a lot of boomers nearing or in retirement age with a lot of employer stock in these plans who don't understand these rules. And I told you that I used to work with a book of employers. So before I did that, I've held a number of different roles with Pentegra, as Lizzie mentioned, but before I did that, I used to work with employees as an education specialist for actual employees in these plans. And I know this to be true because I used to ask the question, and it was always the same answer. So this is definitely worth bringing up with your retirement plan employees that you work with, and also on the employer side if stock is in those plans. All right, we have one final topic where we can, have a hand in setting the framework of the retirement plan DNA, but where, there are so many different ways that it can be expressed among people. And again, this is one that I think is underutilized, understood, and something that I think that more people should know about, and that is DB lump sum payouts. So about 10% of private U.S. employees currently offer defined benefit plans, but 23% of workers participate in DB plans. So remember how I said before that there's that opposite relationship between rates and DB plans? Well, again, if I'm a retirement plan practitioner looking for an emerging revenue opportunity, DB plan terminations and associated counseling regarding distribution of those assets would be a huge one. Because as employers are de-risking due to this inverse relationship between rates and liabilities, they're doing things like adding lump sum windows and terminating their DB plans. Now, back again, when I used to provide employee level consulting services, we did a lot of lump sum windows. And, you send people a letter and they get very confused because they don't know what you're asking of them. They don't know what it means. They're not able to compare a lump sum calculation to, an annuity payment and really do that critical thinking to figure out what is the right option. So expression of those retirement plan genetics is key here. And it really depends on the person. If I am a conservative type of person, and I don't mean, politically or anything like that, I mean investment-wise. If I don't feel comfortable with risk, if the stock market ups and downs make me nervous, or if longevity runs in my family or in the families of people that I'm providing these services to, those are reasons for me to perhaps choose an annuity. And if my pension plan is terminating and they're offering me a lump sum, again, I might not know to ask myself these questions to do this due diligence. But we, as retirement plan practitioners, have the opportunity to provide these services that are very in demand to people right now due to the movement in rates that they otherwise wouldn't have. Now, on the flip side, if I feel comfortable with managing assets, or if I have an advisor that I feel comfortable with, again, I'm wearing my participant hat here, or if longevity doesn't run in my family, or if beneficiary designation and estate and trust planning was very important to me, then I would probably take the lump sum. But again, how would a participant know to ask themselves these questions if this isn't something that they are, steeped in every day like we are? They don't. So each one of these items that we discussed today, as you can see, had kind of a little summary slide with takeaways for employees and for plan sponsors and employers. So I would recommend, using this as a framework. You can use this when you do your next plan review. You can use this when you do your next, if you do an asset review for a participant. Just go through, have them make that list that we saw at the beginning, identify the plans that they have, and then identify any of these special provisions that people can use to their advantage. So again, you can ask, are you familiar with lump sum and pension? If yes, then you can, explain a little bit more about it. If no, then you can do just like we did with the other features, review the plan documents, discuss differences like we just did, pros and cons, and then identify how the lump sum amount is calculated. If the employer doesn't offer the lump sum, this again would be a consulting opportunity with them, where you can do the same thing, but on their level. Explain why a lump sum offering is beneficial at this specific time. Again, movements in rates, de-risking your plan, reducing PBGC premiums. There are lots of reasons to consider it on both sides of the spectrum. And we, as practitioners, when we, put on both of those hats to understand the respective experiences of these different players, we do everybody, a positive service. So with that said, we are down to our final polling question now. Which of the following statements is true regarding a defined benefit plan? A, all DB plans must offer an annuity as a form of benefit payment. B, all DB plans must offer a lump sum as a form of benefit payment. C, all defined benefit plan annuity payment is eligible for rollover. And D, A, and B.
The polling question should now be launched on your screen, and I will leave it up for about 45 seconds to a minute for everyone to select an answer. The polling question is now closed, and the correct answer was A. Kate, you may continue with the summary and next steps.
Great, thank you so much. All right, so I think, or at least I hope, that no matter what type of plan you participate in and or work with in your book of business, you have found something useful today. So if it is a regular garden variety, for example, 401k plan, consider those in-service distribution options. If it is a stock-based plan, consider the impact of the special NUA rules and the consulting opportunity for both employers and employees that exists there. Again, applicable to your 401k plans, consider those after-tax contribution strategies. Are you in the 25% of plans, or is your book of business in the 25% of plans using that feature or not? And if not, is there a reason why, and potentially consider it? And then lastly, consider the business and consulting opportunities that exist around pension payouts, but also why it's important for us to understand the participant experience so that we can accurately provide pros and cons based on an individual's needs. Because ultimately, as we said today, that's really what we were here for today and what we're here for every day, which is to help our retirement plan partners and participants use these plans to the best of their ability and in the way that is most efficient for them. So with that said, I'll turn it back to you, Lizzie, for any questions, comments, or closing remarks.
Great, thank you very much, Kate. And I just want to thank everyone who attended today's webinar. Any questions that were submitted in the box that we did not get to today, we will follow up with you separately. And as a reminder to please complete the survey that will pop up on your screen in just a minute once you close the webinar. And everyone have a great rest of your day. Thank you very much.